China's real estate collapse, a $1.5 trillion market shakeup and its global repercussions. Overview of the crisis. China's real estate market, a cornerstone of its economic growth, is currently facing an unprecedented crisis. This turmoil began with the catastrophic default of Evergrande Group in 2021, marking the onset of a financial disarray that has reverberated through the economy. Over the past few years, key indicators reveal a staggering decline. Construction volumes and home sales have plummeted by approximately 60% from 2020 levels, while housing prices have seen a drastic drop of 40 to 50% by the end of 2024. The real estate sector, which traditionally comprised about 45% of China's financial system, is now witnessing a significant contraction in mortgage lending, which has decreased by about 50%. The crisis stems from a combination of factors: excessive leverage among property developers, stringent regulatory measures introduced by the government, including the Three Red Lines policy, and a drastic reduction in consumer confidence. As of early 2023, estimates suggest that around 60 to 80 million residential properties across China remain unsold and empty, exacerbating the sector's woes. Key events timeline. 1. 2020, the Chinese government introduces the Three Red Lines policy to curb excessive borrowing by property developers, focusing on financial health metrics. 2. September 2021, Evergrande defaults on its debt, triggering widespread panic among investors and creditors and spreading fears of a financial contagion across the real estate sector. 3. 2022, homebuyers initiate widespread mortgage boycotts due to halted construction projects and delayed home deliveries. For 2023, the government begins to relax regulations to restore market confidence. Evergrande files for bankruptcy protection in the U.S. in August. 5. January 2024, a Hong Kong court orders Evergrande to liquidate, marking a significant escalation in the crisis, as Country Garden also warns of potential defaults. 6. 2025, analysts predict stabilization in the real estate market by year-end, contingent on effective government interventions. Underlying causes of the collapse. The collapse of the real estate market is primarily attributed to over-leveraging by developers and the implementation of regulatory measures intended to limit excessive borrowing. The Three Red Lines policy, introduced in 2020, sought to mitigate risks by imposing borrowing caps based on a developer's financial health. However, many companies, notably Evergrande and Country Garden, failed to comply with these limits, resulting in liquidity crises. The real estate market's historical growth led to rampant speculative investments, and the sudden shift in regulatory stance caught many developers off guard. With reduced access to financing, many projects were halted, leading to widespread construction delays and leaving millions of homes unfinished or unsold. As consumer confidence dwindled, prospective buyers became increasingly reluctant to invest in a faltering market. Government response and measures. In light of the unfolding crisis, the Chinese government has initiated several measures to stabilize the real estate sector. Plans include a potential investment of up to 6 trillion yuan to purchase unsold inventory and convert it into affordable housing. Local governments are also encouraged to upgrade urban infrastructure and improve financing conditions for developers to alleviate debt burdens. Despite these interventions, concerns persist regarding the broader economic implications. Job losses in construction and related industries could pose significant challenges to China's economic stability. Some analysts argue that while the situation is dire, it is not comparable to the U.S. subprime mortgage crisis or Japan's prolonged economic stagnation. Global repercussions. The ramifications of China's real estate collapse extend beyond its borders. International investors holding significant stakes in Chinese property firms have experienced substantial losses. Additionally, the interconnectedness of the global economy raises concerns about potential spillover effects, particularly in markets closely linked to Chinese demand. As the world's second-largest economy grapples with these issues, forecasts indicate a slowdown in global growth, particularly in markets reliant on Chinese investments. The International Monetary Fund (IMF) has revised its growth predictions for China downward, further emphasizing the crisis's potential global impact. Outlook for recovery. Looking ahead, while there are signs of optimism regarding a potential recovery post-2025, the future of China's real estate sector remains uncertain. The success of government interventions and the restoration of consumer confidence are critical to stabilizing the market. Analysts suggest that the real estate sector will need to undergo a significant transformation to adapt to new economic realities, possibly leading to a more sustainable development paradigm. In conclusion, China's real estate collapse represents a significant market shakeup with profound implications for both the domestic and global economy. As the situation evolves, careful monitoring of market responses and ongoing developments will be essential to understanding the full scope of the crisis and its long-term effects. The content discusses China's real estate crisis, highlighting the significant economic implications of the collapse of major property developers like Evergrande. Here are some counterintuitive insights identified in the analysis. 1. Comparison with U.S. subprime crisis. A common assumption is that China's real estate crisis will mirror the U.S. subprime mortgage crisis. However, analysts like Huang Qifan argue that the structural differences in China's financial system prevent such a scenario. Unlike the U.S., which allowed zero down payments and leveraged high-risk mortgages extensively, China's government has historically maintained stricter lending practices. This is counterintuitive, as many expect the same patterns of financial contagion to occur in both countries. 2. Government intervention as a stabilizing factor. The expectation is often that government intervention in economic crises exacerbates issues. In this case, however, the Chinese government's proactive measures, such as investing trillions in unsold inventory and improving financing conditions for developers, are seen as necessary to stabilize the market. This contradicts the typical view that government bailouts lead to moral hazard and long-term dependency. 3. The role of urbanization. Many analysts note that China is experiencing a housing surplus because urbanization has not kept pace with aggressive construction. However, Huang Qifan states that there is significant potential for urbanization to continue, suggesting that there is still a long-term demand for housing as rural populations move to urban areas. This perspective challenges the notion that the current oversupply will permanently depress housing demand. 4. Real estate's impact on other industries. It is often believed that a downturn in one sector like real estate will only affect that specific industry. However, the analysis suggests that the real estate sector's decline has broader ramifications impacting over 40 related industries, including construction and manufacturing. This interconnectedness indicates a systemic risk that could lead to widespread economic challenges, contrary to the more isolated view of sectoral downturns. 5. Perception of the crisis as a normal adjustment. The framing of the real estate downturn as a normal adjustment after 2 decades of growth contrasts sharply with the alarmist narratives surrounding economic collapses. While many would expect a crisis to signify a fundamental failure of the economic model, some experts argue that this is simply a necessary correction, allowing for a transition to a more sustainable growth model. 6. Optimism for recovery. Despite the severe downturn, there is optimism among some economists that the real estate sector will stabilize by 2025, allowing for renewed growth. This is counterintuitive given the scale of the crisis, as many would anticipate a prolonged slump akin to Japan's lost decades after its real estate bubble burst. 7. Consumer behavior and confidence. The expectation might be that falling prices would lead to increased buying activity as homes become more affordable. However, the analysis indicates that consumer confidence has significantly plummeted, leading to mortgage boycotts and decreased home purchases. This suggests that market sentiment can often be more influential than pricing dynamics alone, countering the simplistic supply-demand logic. 8. Debt management versus default rates. While high levels of corporate debt in real estate companies are often seen as a precursor to default, the narrative here suggests that effective management and government support can mitigate severe outcomes. The idea that the government can effectively manage a systemic risk without allowing defaults to spiral out of control challenges conventional wisdom about corporate debt crises, leading inevitably to widespread defaults. These counterintuitive insights provide a nuanced understanding of China's real estate crisis, emphasizing the complexities of the economic landscape and the potential for recovery amidst significant challenges. The crisis in China's real estate sector precipitated by the Evergrande default in 2021 has been widely discussed, yet certain critical aspects are often overlooked, which could have significant implications both domestically and globally. Here are several key points that merit deeper examination. 1. Underestimation of housing inventory crisis. One of the most alarming aspects of the crisis is the staggering number of empty homes, estimated between 60 to 80 million. This figure reflects a massive misalignment between supply and demand. Many analysts focus on the immediate financial implications of corporate defaults and reduced consumer confidence, but the sheer scale of unsold inventory signals longer-term structural issues within the housing market. Significance: this excess inventory represents not just financial losses but also a potential social crisis. Many of these homes were purchased as speculative investments rather than for living, leading to a situation where entire developments sit vacant. This can exacerbate urban decay in certain areas, lead to increased social unrest, and further erode consumer confidence in real estate as a viable investment. The psychological impact on future homebuyers, who may see real estate as a precarious investment, can stifle recovery even after the market stabilizes. 2. The role of the three red lines policy. While the three red lines policy is often discussed in terms of its immediate regulatory impact, the long-term implications are less frequently analyzed. This policy constrains developers' borrowing based on their financial health metrics, aiming to reduce speculation and curb excessive debt. However, the stringent nature of these regulations may have inadvertently led to a liquidity crisis for many developers, including Evergrande. Significance: the policy reflects a shift in the Chinese government's approach to managing real estate, moving from growth-oriented strategies to more risk-averse measures. This could signal a longer-term structural shift in how the Chinese economy functions, emphasizing sustainability over rapid growth. Foreign investors and analysts should be wary of how such regulatory frameworks could evolve, affecting investment strategies and the overall economic landscape. 3. Interconnectedness with broader economic factors. The real estate sector in China is deeply intertwined with various economic indicators. Historically, real estate accounted for approximately 45% of China's financial system. The decline in this sector hasn't just impacted housing prices, it has potential ripple effects across multiple industries, including construction, manufacturing, and even retail. Significance: the interconnectedness means that a downturn in real estate can lead to widespread job losses, impacting consumer spending and potentially leading to an economic slowdown. This situation could create a vicious cycle where reduced income leads to lower spending, further affecting the real estate market and related sectors. Observers often underappreciate how a real estate collapse can amplify other economic vulnerabilities, leading to a more profound and prolonged economic downturn. 4. Potential for government intervention to stabilize markets. While discussions often center on the risks posed by the crisis, the government's response has included substantial financial interventions, including plans to invest up to 6 trillion yuan to stabilize the market and convert unsold inventory into affordable housing. This proactive approach could pave the way for a more sustainable model of urban development. Significance: the government's willingness to engage in significant financial outlays reflects an underlying belief in the necessity of real estate to China's economic fabric. Such measures could prevent a deeper economic crisis, but the effectiveness of these interventions remains to be seen. If successful, This could set a precedent for how other nations manage similar crises, balancing market interventions with the need for fiscal responsibility. 5. Global implications of the crisis. The ramifications of China's real estate collapse extend beyond its borders. As a major player in the global economy, a slowdown in China can lead to reduced demand for commodities, impacting economies worldwide. Additionally, foreign investors exposed to Chinese real estate through bonds or equity may face significant losses, leading to a loss of confidence in emerging markets. Significance: understanding the global interconnectedness of financial markets is crucial. The potential for a contagion effect where financial distress in one region leads to a broader pullback in investment could be underestimated, as China acts as a key driver of demand for commodities and goods. A downturn could lead to deflationary pressures in economies reliant on Chinese demand. 6. Consumer confidence and behavioral economics. The crisis has notably diminished consumer confidence in the real estate market, as evidenced by the mortgage boycotts occurring in response to construction delays and defaults. Many homebuyers feel trapped in a system that has failed to deliver on its promises, leading to widespread disillusionment. Significance: the psychological aspect of consumer behavior in the real estate market is critical. As consumers become increasingly skeptical of the reliability of property investments, their willingness to engage in future purchases diminishes, thereby stalling any potential recovery. Addressing this erosion of trust requires not just financial measures but also effective communication and transparency from both the government and developers. 7. Long-term urbanization trends and housing needs. China's urbanization rate is still at about 48%, with significant room for growth. The structural issues within the real estate market must be viewed against this backdrop of urbanization that is ongoing. Significance: the long-term housing needs of a growing urban population could create demand that ultimately stabilizes the market. However, the current oversupply and consumer hesitance complicate the scenario. Policymakers will need to strike a delicate balance between addressing immediate crises and planning for future housing needs. Failure to do so could lead to further imbalances in supply and demand. Conclusion: the crisis in China's real estate sector presents a multifaceted challenge that requires careful navigation. While the immediate financial implications are apparent, the broader social, psychological, and economic ramifications should not be overlooked. Understanding these complexities is vital for stakeholders both within China and globally, as the outcomes will likely shape economic strategies and policy decisions for years to come. The situation remains fluid, emphasizing the need for continued monitoring and adaptive strategies in response to evolving market conditions. 1. Impact of over-leveraging and regulatory changes. The collapse of China's real estate market can be traced back to the excessive debt accumulated by property developers, notably highlighted by the downfall of Evergrande Group. The introduction of the 3 red lines policy in 2020 aimed to impose strict borrowing limits to mitigate risks associated with high leverage. However, many developers violated these limits, leading to liquidity crises and widespread defaults. This situation has resulted in a significant decline in construction volumes and home sales, with estimates showing a drop of around 60% from 2020 levels and a staggering number of empty residential properties, exacerbating the crisis. The regulatory changes, while necessary to curb speculation, have created a ripple effect throughout the economy, leading to reduced mortgage lending and overall economic instability. 2. Government response and market stabilization efforts. In response to the crisis, the Chinese government has implemented extensive measures to stabilize the real estate market, including potential investments of up to 6 trillion yuan to acquire unsold inventory and convert it into affordable housing. Plans to upgrade urban infrastructure and improve financing conditions for developers have also been announced. The government's strategies aim to reduce the debt ratios of developers significantly from levels around 80 to 90% down to approximately 50%. These interventions are critical for restoring consumer confidence and stabilizing the housing market. which has historically accounted for a significant portion of China's financial system. 3. Comparative analysis with global real estate crises. Analysts have drawn parallels between China's real estate crisis and historical events such as the U.S. subprime mortgage crisis and Japan's prolonged economic stagnation. However, experts like Huang Qifan argue that the structural conditions in China differ significantly. Unlike the U.S., where risky lending practices led to a widespread financial collapse, China's regulatory environment has historically prevented such practices. The significant differences in urbanization rates and economic structures suggest that while the current crisis is severe, it may not lead to a prolonged economic downturn akin to Japan's experience in the 1990s. Understanding these comparisons is vital for assessing the potential implications of China's real estate collapse on the global economy. For future outlook and economic implications, the long-term outlook for China's real estate sector remains uncertain, hinging on the effectiveness of government interventions and consumer confidence restoration. Analysts predict that by 2025 the market may stabilize, marking the beginning of a new development paradigm. However, concerns about interconnectedness between the real estate sector and the broader economy persist, particularly regarding potential job losses in construction and related industries. The future trajectory of the housing market will significantly influence China's overall economic stability and growth, making ongoing monitoring and analysis essential for understanding the potential global repercussions of this crisis. 1. The U.S. subprime mortgage crisis 2007 to 2008. The U.S. housing market faced a catastrophic collapse due to extensive lending practices that allowed individuals to purchase homes with little to no down payment. Financial institutions bundled risky mortgages into securities which were sold to investors. When homeowners began defaulting on loans as housing prices plummeted, it led to a national financial crisis with high-profile bankruptcies like Lehman Brothers causing a global recession. 2. Japan's lost decade 1991 to 2001. Following an asset price bubble in the late 1980s, Japan's real estate and stock market crashed in the early 1990s. The bubble burst led to a prolonged period of economic stagnation, deflation, and a banking crisis due to the high levels of non-performing loans. The government struggled to implement effective policies to revitalize the economy, leading to a prolonged recovery phase often referred to as the lost decade. 3. The 1997 Asian financial crisis, sparked by the collapse of the Thai baht. This crisis quickly spread to neighboring countries including Indonesia, Malaysia, and South Korea. A combination of high debt levels, over-leveraged banks, and a lack of foreign reserves led to massive currency devaluations, stock market crashes, and economic downturns across Asia. The crisis underscored the vulnerabilities of emerging markets to rapid capital inflows and outflows, and it prompted significant reforms in financial regulations in the affected countries. The future outlook for China's real estate sector following its significant collapse and the implications it has on both domestic and global economies is complex and multifaceted. Here are some predictions and insights into how the situation might evolve over the next several years. 1. Market stabilization by 2025. Analysts, including prominent economists like Huang Qifan, predict that by 2025, the Chinese real estate market will begin to stabilize. The government's aggressive measures to address the ongoing crisis, such as financial support for developers' investment in affordable housing and infrastructure upgrades, are expected to yield results. The focus will likely shift towards a new development paradigm that emphasizes sustainability and affordability rather than speculation. 2. Government intervention and support. The Chinese government is likely to continue its interventionist approach, which has previously included allocating substantial funds towards acquiring unsold inventory and converting properties into affordable housing. This could lead to a significant increase in state-owned affordable housing units, potentially addressing the housing needs of lower-income families and stabilizing market demand. 3. Gradual recovery of consumer confidence. As the government implements policies aimed at restoring confidence, such as relaxed mortgage lending conditions and incentives for homebuyers, consumer sentiment may gradually improve. This could lead to increased home sales and a slow recovery in housing prices, albeit at a more sustainable level compared to the pre-crisis highs. 4. Shift in developer strategies. Many property developers will likely reassess their business models in light of the crisis. Moving away from aggressive expansion and high-leverage strategies, firms may adopt more conservative approaches focusing on financial health and sustainable development. This includes adhering to the 3 red lines policy to manage debt levels more effectively. 5. Impact on employment and economic growth. The construction sector, which has traditionally been a major driver of employment in China, will face challenges as the real estate market stabilizes. Short-term job losses are expected, particularly in construction and related industries. However, as the market stabilizes and new projects emerge, employment may rebound, contributing positively to overall economic growth. 6. Real estate as a long-term investment. In the longer term, real estate may regain its status as a preferred investment vehicle, but with a shift towards cautious investment strategies. Investors will likely demand transparency and sustainable practices from developers, and the focus may shift away from speculative investment towards properties that meet genuine housing needs. 7. Global economic repercussions. China's real estate crisis has already had global repercussions affecting foreign investments and supply chains. As the market stabilizes, foreign investors may regain confidence, leading to renewed investment flows into China. However, potential risks remain, especially if the recovery is slower than anticipated or if external economic conditions worsen. 8. Continued regulatory changes. The regulatory landscape surrounding real estate in China is expected to evolve continuously. The introduction of property taxes and further restrictions on borrowing may be implemented to promote a healthier market environment. These regulations will likely aim to prevent another bubble and ensure that property remains affordable for the average consumer. 9. Urbanization and housing demand. China's ongoing urbanization will continue to drive demand for housing, particularly in Tier 2 and Tier 3 cities. As rural populations migrate to urban areas, the need for affordable housing solutions will remain critical, presenting opportunities for developers who align with government initiatives and consumer needs. 10. Technological integration in development. The future of real estate development in China may see increased integration of technology, including smart city initiatives and green building practices. Developers who adopt innovative construction methods and sustainable practices are likely to be better positioned in the evolving market landscape. Conclusion. In summary, while the road to recovery for China's real estate sector is fraught with challenges, the combination of government intervention, regulatory adjustments, and shifts in consumer behavior and developer strategies suggest a gradual stabilization by 2025. The focus will likely be on sustainable development, affordability, and restoring consumer confidence, which could ultimately reshape the future of real estate in China and its impact on the global economy.